Three separate forces hit US equity futures at the same time this morning, and when pressures stack like this, markets tend to feel it. Stock futures fell in early trading as investors pulled back from technology shares, bond yields pushed higher, and concerns about Iran added a cautious undertone across asset classes. None of these pressures is new on its own, but when they converge in the same session, the combined weight on sentiment can be heavier than any single factor would produce alone. Start with technology. Tech stocks have been the primary engine of Wall Street's gains in recent years. When that sector stumbles, it pulls broader indexes with it. A sharp move lower in tech names can mean different things. Concern about stretched valuations, slowing earnings growth, or simply profit-taking after a strong run. Any of those explanations can become self-reinforcing in a risk-off session, where selling begets more selling. Rising bond yields are adding a separate layer of pressure. When yields on US Treasuries move higher, borrowing costs rise across the economy. At the same time, bonds start to offer more competitive returns against stocks, returns that come with a guarantee, not a risk. That math tends to hit high-growth technology companies hardest. The appeal of those companies rests largely on future earnings, and future earnings are worth less today when you discount them at higher interest rates. So rising yields and tech valuations pull in opposite directions, and right now, yields are pulling harder. The third headwind is geopolitical. Tensions involving Iran have introduced uncertainty that markets do not price easily. When conflict risk rises in the Middle East, oil prices often follow. Higher oil can stoke inflation concerns and prompt investors to shift towards safer assets, treasuries, the dollar, gold. That defensive rotation pulls money away from equities, reinforcing the move already underway in futures. A few important caveats. Futures moves do not always carry through to a full trading session. Once formal trading opens, economic data, earnings reports, or shifts in the news cycle can stabilize or even reverse the early mood. So the opening picture is not necessarily the closing picture. What does this mean for investors watching today's session? The most useful thing to track is whether these three pressures are moving in the same direction or starting to diverge. If bond yields stabilize and geopolitical headlines calm, the tech sell-off may find a flaw. If all three continue pressing in the same direction, yields up, oil up, tech down, expect the cautious tone to persist through the session. Watch those three data points together, not in isolation. This briefing is brought to you by First Financial News. Clear, daily coverage of the economy and markets at firstfinancialnews.com.